Principal preservation continues to be an emphasis in 2019, given the risks of an aging credit cycle and rising interest rates. The good news is the portfolio is on track to start the new year with a higher yield than it had 12 months ago. Portfolio duration is still quite defensive at around 1 year, but we think we are getting closer to the end of the Fed's tightening cycle. So we will look for opportunities to extend out the yield curve and lock in higher yields. We generally favor higher quality credits at this point in the cycle, and we believe the portfolio is flexible enough to take advantage of any value opportunities that may arise along the yield curve or in the credit markets.
We believe agency mortgage-backed securities currently offer favorable risk-adjusted returns, particularly when viewed in the context of recent underperformance in the agency market, tight spreads in credit markets, and our view that we are late in the credit cycle. Additionally, due to rising mortgage rates, most borrowers do not currently have an incentive to refinance, so prepayment and extension risks should not be a major concern. MBS spreads currently look attractive, and we think that patient investors could capture attractive returns over time. Securitized credit, particularly ABS, is another area we continue to favor for several reasons. In our view, consumer, real estate, and the economic backdrop look relatively solid. With these supportive fundamentals and low supply, we think securitized credit could generate attractive risk-adjusted returns over the next year. However, spreads have remained tight and the curve is fairly flat, so we prefer to take more credit risk in short-duration securities and emphasize higher quality further out the curve.
Over the past year, we have aggressively pulled back on credit risk in our portfolios. Looking ahead, we think macro risks and changes in market supply and demand dynamics could make things even choppier for investors. The Federal Reserve is raising rates, other central banks are slowly reducing stimulus, and U.S. trade negotiations with China remain uncertain. At this point in the cycle, investors should be very selective. We are focused on identifying improving credit stories and avoiding those names that do not offer enough compensation for possible downgrade and default losses. We have increased reserves, and we are monitoring investment grade and high yield markets and assessing capital flows for attractive opportunities to redeploy them.
As EM equity investors, we continue to see opportunities in what we believe are high-quality companies with potential to be structural long-term winners in their markets. Some examples include financial companies with high-quality balance sheets that have demonstrated underwriting capabilities over a credit cycle, consumer stocks with strong product pipelines and brands, and technology companies with sturdy network effects and winner-take-all dynamics. Even though China is a big part of the investment universe, we will continue to have low exposure there because we see a lack of high-quality companies.
The Fed appears more data-dependent as we enter 2019, with multiple rate hikes now in question. While we expect economic growth in the U.S. to continue, we remain cautious on global growth. Our portfolio strategy in 2019 is to maintain a yield advantage relative to the benchmark. In terms of adding additional risk and duration, we continue to take a patient approach in this flatter yield curve environment.
Technology is currently changing the way business is done. For example, consumers and businesses can easily see prices across markets, pressuring businesses to constantly demonstrate value for price. As a result, we have eliminated some portfolio holdings that relied on extensive physical distribution networks as a main strength. We currently hold positions in industrial companies that are using technology to go direct to their customers, thus increasing their margins and strengthening the customer relationship. We also have a number of holdings in consulting companies with strong technological expertise. We feel these firms are well positioned to help their clients adapt their business models to this new environment.
In terms of positioning, we see value across asset classes in emerging markets. But emerging markets can be volatile, so we invest tactically and take smaller positions. We also believe there are opportunities in Europe, but slower economic activity and the ECB's plans to taper are risks to watch. We expect volatility to remain in focus as global central banks pull away from QE. Investors should be tactical and seek investments across a range of asset classes as a way to help increase diversification and navigate challenging markets.
Short-duration fixed income opportunities are certainly more prevalent today than they were a year ago. We believe that the steady rise in interest rates and wider credit spreads are creating value in fixed income securities at the front end of the yield curve. Today, high-quality securities like asset-backed and corporate bonds with 2 to 3 year maturities, are offering yields of 3% or better. These securities are currently competitive with equity dividends and assets held in money market funds, so we continue to favor investing in ABS and corporate bonds in our short-dated portfolios.